You worked for 40 years to build your retirement savings. But here's the terrifying part. The biggest financial mistake of your life could happen after you retire. Because once the paycheck stops, a market crash, inflation, or one bad investment decision can permanently damage the money you spent decades building. So where should your retirement money actually go? Stocks, bonds, CDs, treasuries, real estate? And more importantly, how do you make your money last for the rest of your life? Today we're breaking down 7 smart options retirees should know about. Retirement changes the rules of investing. Before retirement, your biggest advantage is time. You can experience market crashes, wait for recoveries, and continue adding money to your portfolio. But after retirement, you're doing something completely different. You're taking money out. That creates a problem called sequence of returns risk. If the market falls heavily during the first few years of retirement while you're also withdrawing money, your portfolio can be damaged much more severely than if the same crash happened later. That's why a retirement portfolio isn't simply about maximizing returns. It's about balancing growth, income, safety, liquidity, and inflation protection. So let's look at 7 options. The first option is probably the least exciting, and that's exactly why retirees shouldn't ignore it. A high-yield savings account. This isn't where you necessarily want to keep your entire retirement portfolio, but it can be extremely useful for money you'll need soon. Think about emergency expenses, medical bills, home repairs, insurance deductibles, or several months of living expenses. The advantage is simple. Your money is highly liquid and you aren't exposed to stock market volatility. But there's a catch. Savings accounts may not keep pace with inflation over long periods, so cash is excellent for stability and short-term needs. It isn't necessarily the best tool for preserving purchasing power over decades. The key question isn't, should retirees have cash? They probably should. The better question is, how much? Number 2, U.S. Treasury securities. Treasury bills, notes, and bonds are debt securities backed by the U.S. government. For retirees looking for relatively conservative investments, treasuries can play an important role. Why? Because instead of relying entirely on stock market growth, you can use high-quality government debt for part of your portfolio. Treasury bills are generally short-term securities. Treasury notes have intermediate maturities. Treasury bonds are longer-term. And then there's another interesting category. TIPS, Treasury Inflation-Protected Securities. TIPS are designed to provide protection against changes in inflation because their principal value adjusts based on inflation. That makes them particularly interesting for retirement planning. But remember, government-backed doesn't mean every Treasury investment has no risk. Bond prices can move when interest rates change, especially if you sell before maturity. So the purpose here isn't to find one magical investment. It's to create a portfolio where different pieces have different jobs. Number 3, certificates of deposit, or CDs. A CD allows you to deposit money with a bank for a specific period in exchange for an interest rate. The appeal is predictability. You generally know the maturity date and the interest structure when you buy the CD. For someone who doesn't want their entire retirement portfolio exposed to daily stock market swings, CDs can provide another relatively conservative component. But there's a major consideration. Don't automatically lock up all your money for years. Retirees still need liquidity. One approach some investors consider is a CD ladder. Instead of putting $100,000 into one 5-year CD, you could divide money among CDs with different maturity dates. For example, one portion matures next year, another the year after, another later. That can create a rolling source of liquidity while still allowing you to earn interest. And depending on the institution and account structure, FDIC insurance limits also matter. Always understand the coverage before assuming all your deposits are protected. Number 4, bonds and bond funds. Bonds can provide interest income and diversification away from stocks. But there is something retirees absolutely need to understand. Bonds are not the same thing as cash. When interest rates rise, existing bond prices can fall. And bond funds don't have a guaranteed value simply because they're called bond funds. That's why retirees need to look beyond the word bond. They need to understand duration, credit quality, interest rate risk, and how the investment fits into the rest of the portfolio. For example, a short-term high-quality bond fund serves a very different purpose from a long-term corporate bond fund. The lesson is simple: don't buy an investment because it sounds safe. Understand what actually creates the risk. Now we move into the growth side of retirement investing. Number 5, dividend-paying stocks. This is where many retirees get interested. Why? Because dividends can provide cash flow while allowing the underlying investment to potentially grow. But here's where people make a dangerous mistake. They see a stock yielding 8%, 10%, or even more and assume higher dividend equals better investment. Not necessarily. Sometimes an unusually high yield is a warning sign. A company may be struggling, its stock price may have fallen dramatically, or its dividend may not be sustainable. Instead of focusing only on yield, investors should consider the company's financial health, dividend history, valuation, and overall business. And remember, dividends are not guaranteed. Companies can reduce or eliminate them. So dividend stocks can potentially play a role in retirement income and long-term growth, but they're still stocks. Their prices can fall. Prices. Number 6 is one of the most important. Broad market index funds. Retirement can last 20, 30, or even more years. That means retirees still need growth. Why? Because inflation doesn't retire when you do. Imagine you retire at 65. If your money earns nothing for the next 25 years while prices continue rising, your purchasing power can shrink dramatically. That's why some retirees maintain exposure to stocks, but instead of trying to identify the next Apple, Amazon, or Nvidia, a broad market index fund can provide exposure to many companies at once. For example, an index fund tracking a broad U.S. stock market index can spread your investment across hundreds or even thousands of companies, depending on the index. The benefit is diversification, but there's an important warning: index funds can still fall significantly. There is no guarantee that the stock market will go up when you need it to. That's why the amount of stock exposure should match your risk tolerance, financial situation, spending needs, and time horizon. The goal isn't to eliminate risk, it's to take the right amount of risk for your situation. And now we reach number 7, investments designed to help protect purchasing power. This category can include assets such as real estate, tips, and, depending on an investor's overall strategy, other real assets. Why does this matter? Because one of the biggest retirement risks isn't simply losing money, it's losing purchasing power. If your retirement income buys less and less every year, your lifestyle can gradually become more expensive even if your account balance looks stable. Real estate can potentially generate rental income and appreciate over time, but it also comes with major responsibilities: property taxes, maintenance, insurance, vacancies, management, and liquidity problems. You can't always sell a house as easily as you can sell a diversified investment fund. But here's the part most retirement videos don't emphasize enough. The biggest mistake isn't necessarily choosing the wrong investment, it's building a retirement portfolio where every dollar has the same job. Your emergency money has a different job from your long-term growth money. Money you'll spend next year has a different job from money you may not touch for 20 years. That's why retirees often need to think in layers. Layer 1, liquidity, money you may need soon. Layer 2, stability, investments designed to reduce the impact of market volatility. Layer 3, growth, assets that can potentially keep pace with inflation and support a long retirement. And potentially, Layer 4, income, investments designed to generate cash flow. The exact percentages shouldn't come from a YouTube video. They should depend on your spending, Social Security, pension income, taxes, healthcare costs, other assets, risk tolerance, and expected lifespan. Think about retirement investing this way. You're not trying to win a race, you're trying to build a bridge. That bridge needs to survive market crashes, inflation, unexpected expenses, longer than expected retirement, and changing economic conditions. That's why the best retirement strategy for one person can be completely wrong for another. A retiree with a large pension and low expenses may be able to take more investment risk. Someone depending almost entirely on their portfolio for monthly income may need a very different structure. There is no universal percentage, there is no magic stock, and there is no investment that removes every risk. So where should you invest your money after retirement? The answer probably isn't, put everything into one investment. Instead, think about what each dollar needs to accomplish. Some money may need to be accessible, some may need stability, some may need to generate income, and some may need to keep growing so inflation doesn't quietly destroy your purchasing power. The real goal of retirement investing isn't to become rich as quickly as possible. It's to give yourself the best chance of staying financially independent for as long as you live, and that's a very different game. If you found this useful, subscribe to Capital Invest for more straightforward explanations about investing, retirement, taxes, and building long-term wealth. And remember, the goal isn't simply to retire with money. The goal is to make your money last throughout retirement.